Let us begin. REI USA welcomes you to tonight's webinar of the impact of the whole pandemic and coronavirus and all that, and how it's impacted investment real estate. So we'll get some immediate use education. It's not a topic from years ago, definitely. So let me bring in Erik. He loves saving real estate investors lots of money. He even educates CPAs from around the country on helping them with their real estate clients. He holds an accounting degree from Westminster College. And earlier, he was operations manager for a multi-million-dollar landscaping and design firm. So he's been on every possible end of a transaction, which is good to know. If you like, as we're going along, send some questions through on the chat, and we'll allow some time for questions and answers at the end. Erik now, of course, is Southwest Regional Manager for Cost Segregation Authority. So let's get right into our presentation. Erik, thanks for your patience as well as the panelists tonight, and we're anxious to hear. So take it away, Erik.
Sure. No, thank you. Glad we were able to get the audio and video working. I think we're all set now. So like Dave said, my name's Erik Oliver. I'm with a company called Cost Segregation Authority. And what we do is we work with real estate investors and CPAs on basically accelerating depreciation. So we'll walk through here in just a second kind of what cost segregation is. But basically, we all get into real estate for a number of different reasons. But one of the main reasons is for the tax write-off. So when you own real estate, the IRS allows you to depreciate that real estate over either 27 and a half years for residential properties or 39 years for commercial properties. And what we do at our firm is we do engineering-based studies to accelerate that depreciation. And there's a number of reasons why you would do that. We can get into some of that later. But what I really want to talk about today is when you accelerate that depreciation, there's a number of things that have happened recently. First, with the Tax Cuts and Jobs Act. That was the 2017-18 Trump tax revisions. First with that, and then secondly, with the recent coronavirus stimulus packages that have been rolled out. There's a few provisions in there that really affect us as real estate investors that I wanted to talk about today. So that's kind of the agenda. We're going to do a quick overview on cost segregation just to give you a foundation on how this works and how, with the recent changes, it's become even more. The first thing, like I mentioned, is depreciation. So the IRS allows us to depreciate our assets. Again, if it's a commercial asset, it's over 39 years. The residential is over 27 and a half. And what cost segregation is that's just an acceleration of those deductions. So just to make the math easy, let's say you've got a $275,000 asset. Essentially, if you don't do cost segregation and it's a residential rental, you're going to get a $10,000 write-off every year for 27 and a half years. So you take that 275, divide it by 27 and a half, and you get $10,000 worth of deductions every year that you can use to offset your income. Now, that's standard straight line deductions. That's no acceleration. By doing cost segregation, we'll come in and we segregate out the different components of your building. So think about if you buy a duplex, not only do you buy the land and the walls, but you also buy the cabinets, the countertops, the flooring, the lighting, the appliances. There's a number of different components within that building that you also purchase at the time that you acquire the property. And so cost segregation, what we do is we come in, we put a value to all those different components, and then the IRS tells us that your carpet, for example, is a 5-year asset, not a 27 and a half year asset. So now you can depreciate your carpet over 5 years, your countertops over 5 years, your curbs, gutters, and asphalt over 15 years. And again, what you're doing is front loading or accelerating your depreciation so you can take those deductions now versus in the future. You know, a dollar today is worth more than a dollar 27 and a half years from now. So give me my deductions today and let me reinvest that money, go buy new properties, do what I want with it. But that's kind of the basis of cost segregation and how it works. So there's different property classifications. Again, a lot of you guys, when you buy your properties, you'll hand over your closing statement to your CPA. And what you see on your taxes is you see on your depreciation schedule, it says building, 27 and a half year asset, you know, $300,000 or whatever you paid for it. minus the land. You don't get to depreciate land, so you always have to minus the land out. So what we're saying is, instead of putting that whole asset as one big lump sum on your depreciation schedule, let's break it up into little components so that we can accelerate the deductions faster. And so here's the different categories. You've got your 5-year category. That's your personal property, things like countertops, cabinets, lighting, portions of the plumbing, portions of the electrical, wall covering, etc. Then you've got your 15-year assets. Your 5 and 7 are your personal property. There's not a lot of 7-year assets when we're talking about residential rentals, maybe some telecommunication stuff, but most of it falls into the 5-year category. Then you've got your 15-year category. Those are things like parking lots, curbs, gutters, asphalt, irrigation, storm drains, retaining walls, all your land improvements, all your outside stuff. And then the rest of it gets classified as long-term assets or 27.5-year assets. And that's things like curbs, gutters, those are the walls, the structural components, roof, walls, windows, HVAC, etc. So you can see we're taking it from one single large asset and dividing up into 4 categories: 5, 7, 15, and 27.5 or 39-year. And those are the different kinds of items that you would find in those categories. Now, let's do a quick case study here. Just looking at a residential assisted living home. Let's say you bought it for $1.5 million. You determined that $300,000 was the land value, so you take that out of the equation. So you're left with $1.2 million of what we call depreciable basis. You buy it in 2019, the tax year is 2019. So on this property, we go in, we identify and put values to these different components, your 5-year, your 15-year assets, etc. And this is what it looks like once we've done that. So you can see that if you don't do cost segregation, over on the left-hand side, you basically take the 1.2 million divided by 27.5, and you get a $43,000 write-off every year. That's $43,636 every year for the next 27.5 years. That's this number. I see if I can use the pin here. You see $43,000, that just goes all the way down. You get that same deduction every year for the next 27.5 years. By doing a cost segregation study, we've now identified 5-year assets, these are bad circles, 7-year assets, 15-year assets. In this example, we found $216,000 worth of 5-year assets. So now, instead of depreciating this 5-year assets over 27.5 years, you get to depreciate them over the first 5 years. So instead of a $21,000 write-off in the first year, you now have a $65,000 write-off in the first year. That's a difference of $43,000. Take that $43,000 times your tax bracket, that's a $17,000 tax savings. So remember, these are non-cash expenses. So you take these deductions, they act just like an expense. If your income, let's say my income's $100,000, but I have a $65,000 deduction, instead of being taxed on $100,000, now I'm only taxed on $35,000. And so that's where the tax savings comes in with cost segregation. So you'll see that we've identified the 5-year, the 7-year, and then the 15-year. So you're accelerating all those categories. At the end of the day, again, you have a $43,000 worth of additional deductions, resulting in a $17,000 tax savings. Now that's calculated at a 35% marginal rate. So, if you're in a higher tax bracket or lower tax bracket, that may go up or down, but that's $17,000 savings in that example. That example right there was what would happen before the Tax Cuts and Jobs Act. So again, we take our 27.5-year asset, we divide it up in different parts. We take our 5-year assets that we've identified and depreciate those over 5 years, 7 over 7, 15 over 15, which is great. That's what we were doing before the changes to the tax law. And you can see it was worth it because we were getting a $17,000 tax savings. All right, so can this be, a question we get asked quite often is, can I do this on a property that I've owned for a number of years? Let's say I bought it in 2014, I'm doing my 2020 taxes. I've never done cost segregation. Can I do it on my current asset? The answer is absolutely, and you don't even have to go back and amend your tax return. So there's a form that we fill out as part of our service. It's called a 3115 tax form. But basically, you're telling the IRS, hey, I've been taking this straight line standard deduction for the last 7 years, 6 years. I now want to accelerate it, and here's the difference in those numbers. And again, you can do it without amending your tax return. You just have to submit that form. So in this same example, this $1.2 million property, let's say we bought it in 14. Now, all of a sudden, I'm taking the first 7 years of deductions, and I get to take all that increase in the first year. So again, year one, I got 65,000 that I was eligible for, but I only took over here on the left, 21,000. Year two, I only took 43,000, but I was eligible for over here on the right, 113. So when you add up all the differences in those numbers, you come up with a $203,000 deduction in the first year. That's massive. You think about your income. If let's say I make $300,000 a year, instead of being taxed on $300,000, I do a cost seg on this property. Now I'm only taxed on $97,000. At the end of the day, that equates to about an $81,000 tax savings without having to amend my return. So definitely can be done on properties that you've owned, that you've already depreciated. Now, you wouldn't want to do it on something that maybe you've owned for 25 years because you've already taken most of the deductions in that property, and there's not a lot for us to accelerate. But anything 15 years or less, if you've owned it, it's definitely worth us looking at to see if there may be an opportunity for us to accelerate some of those deductions. Excuse me, when would you do a cost segregation study? Like we mentioned, if you currently own an income generating property, can't be done on your primary residence, it has to be a revenue generating property. If you purchase an existing building or build a new building, if you renovate, remodel, or make leasehold improvements, and also before the sale. And we'll talk about that one here in a second. That can get a little confusing, but you're thinking, oftentimes when you sell a property, you have to pay what they call a recapture tax along with your capital gains tax. So, and the recapture tax is calculated based on how much depreciation you've taken. So oftentimes people say, well, why do I want to take all this depreciation if I'm going to turn around and sell it and have to pay it all back? And we'll kind of walk through an example there in a second. And then if you have a property with any kind of step up in basis would be another good time. All right, so let's talk about the sale of an asset. Like I mentioned, when you sell a property, you not only do you have to pay the capital gains tax, you also have to pay what they call a recapture tax on the depreciation you've taken. So that's where people will ask us, okay, if I have to pay a recapture tax on the amount of depreciation I've taken, why do I want to take all this depreciation? Don't I just have to pay more tax? And the answer is no, for a couple of reasons. One, there's a time value of money element. Give me my deduction today. If I sell my property in 5 years, even if I have to pay it all back 100%, I've basically got an interest-free loan from the government, right? I've had this money sitting there that I've been able to use to reinvest in new properties. That's one reason. The second reason is you're taking your deduction today against your ordinary income, and you're paying it back at a 20% capital gains rate, 20 to 25%. So if I take a 40% deduction today and pay it back at 25% in 5 years, I get to keep the 15% as a permanent tax savings. So take your deduction today at a high rate, pay it back at a future date at a lower rate, keep the spread, right? And then the third one is you get to reduce or eliminate the recapture on personal property. And so let's talk about that for a second. I'll go to this next example here. Let's walk through the example, then I think it'll make more sense. But let's say you buy an apartment in 2012 for 2.5 million. You sold it 5 years later for 3.3 million. So you gained $800,000. You bought it for 2.5, sold it for 3.3 after holding it for 5 years. If you don't do cost segregation, there's two types of tax you pay on this. You're going to pay your recapture tax, which is here, of $500,000. That's the amount of depreciation you've taken times that 25% tax rate. So that's a total tax bill of $125,000. Then you also pay the capital gains tax on the $800,000 gain. And in this example, we used a 20% capital gains rate. You add those two numbers together, the 160 plus the 125, you get a total tax bill over here of 285,000. So you don't do a cost segregation study. You make $800,000 on your apartment complex. You're going to have to send a check to the IRS for 285. So nobody likes to write that check. I'll tell you that right now, but it's one that we all have to write. Now, if you do cost segregation, it's the same concept, but now we've broken it up into these different, I'll call them buckets just for a lack of a better word, but you got your 5-year bucket, your 7-year bucket, 15-year bucket, and your 27.5-year bucket. So on this same property, when we did the cost segregation study, we determined that there was $425,000 worth of 5-year assets. Now, let me ask you guys a question. If I've owned the building for 5 years, what are my $425,000 worth of 5-year assets? What are they worth after 5 years? They're worth zero, right? They're fully depreciated. These are things like carpet, countertops, cabinets. So we've taken all the depreciation that we can on those. And so therefore there's no recapture tax. We're not selling those for a gain. And that's really the most important thing I want you to remember is you don't buy your carpet in 2012 for $20,000 and then sell it in 2017 for $50,000. It doesn't go up in value, right? Your carpet goes down in value. Your walls, your land goes up in value, but your carpet doesn't. And so what happens if you don't do cost segregation is when you buy a building for $1 million and sell it 5 years later for $2 million, you're essentially telling the IRS that, hey, I bought it for $1 million. Everything, my land, my walls, my carpet, my countertops, everything doubled in value. Remember, this is 5-year-old carpet that's now stained and dirty. You're telling the IRS it doubled in value, and now I'm selling it for $2 million. And that's just not the case. Again, your walls and your land go up in value, but your dirty old carpet doesn't. So when you do a cost segregation study, you get to allocate the sales price to the right buckets. And I know there's a lot of numbers here, and it took me a while to understand these numbers myself. I don't expect you to understand them here in the next 30 seconds, but basically at the end of the day, your tax bill down here is 203 versus 285. So that's a savings of $81,000 by doing a cost segregation study and holding the property for 5 years. So again, going back to the previous slide, don't I just have to pay all this back? The answer is no. You pay a portion of it back at a lower rate, and you get to keep all the additional tax savings. So that's an important concept for you guys to understand when thinking about cost segregation. You want to know how long are you going to hold this asset. Even in properties, depending on the size of the asset, you may only have to hold it for 1 year in order to save a bunch of tax money. And we'll run the analysis and let you know. But as long as you hold the property over 1 taxable year, there's a good chance you may be able to save some tax dollars by doing a cost segregation study, taking your deductions today at a high rate and paying back a portion of those at a later date at a lower rate. So anyways, just wanted to point that out. I don't know if we've got any questions here. I'll just take a quick look, but
yeah, Erik, actually a couple of them. One came into me and is pertinent right at this point while you've got the chart up. And the question, I guess, just to kind of summarize and not make it too long-winded, is just to kind of clarify on that it's real estate expenses. So for example, with an apartment, or an even better example, maybe the nursing home, suppose you need to replace the refrigerators in the individual rooms, that's not part of the property. So maybe just a quick overview on what counts toward the real estate cost segregation and kind of what you need to watch for in planning. Maybe there's something that you can kind of purchase that turns into the real estate, if you get my drift. So that's kind of the gist of the question.
No, that's a great question. So if you already own a building and you're going to go into the rooms and replace refrigerators, a couple things. Usually your CPA is going to treat that as repair and maintenance. If those are under $2,500, they're just going to write them off as an expense, and there's no need to capitalize them. So that's the first thing. But if, let's say you buy an existing nursing home and there's already refrigerators in all those units, those are part of your original purchase. And so we want to segregate those out. And allocate them to the right category. So in that case, those appliances would be a 5-year asset, that you would be able to depreciate the value of those over 5 years versus 27 and a half. So if you think about it, someone once used the analogy of a hamburger, which I thought was made a lot of sense. You go to McDonald's, you buy a Big Mac, you pay, I don't know what you pay, $5-6 for a Big Mac. That's just, you're getting everything for $5 or $6. Cost segregation, you would basically go to McDonald's and say, okay, I want to buy a bun for $1.25. I want to buy some ketchup for 75 cents, a pickle for a quarter. You're segregating those different parts of the burger. And that's the same thing we're doing with your building. We're segregating, you're buying the whole thing, the whole asset, the whole retirement community or the whole senior living center for $1 million. But if you think about it, you also just bought 65 fridges in each of those 65 units, right? You bought 65 refrigerators, you bought 7 washers and dryers, you bought 6,000 square feet of flooring. You bought all those different components. You just don't have a value to those because they were existing when you bought the property. And so that's where we come in and put a value on those existing components. That was a good question, though. Hopefully that helps clear that up.
Yeah, I'm
All
sure
right.
it does. The other question that I've gotten would be, and again, since you've got the chart up there, so suppose somebody's sitting here thinking, oh yeah, I've got this property, man, I'd love to do cost segregation, but I've had it for 7.5 years. What happens? They may have lost out on the first few years of these benefits, or have they? And that, along the line of the next question, would be, where do you, or cost segregation, where does it fit in the procedure? When would we contact you? Before we purchase, after we've purchased, any time? So those would be good just as far as how this fits in with a timeline.
Sure, yeah. So again, you can do this, it doesn't matter how long that's the great thing about cost segregation, is it's extremely flexible. It can be used as a tax planning tool. It doesn't matter how long you've done or held the property. And there's not always a right answer when, well, you should just do the cost segregation study right after you buy it, or a lot of it depends on your personal financial situation. So you want to use these deductions when you find yourself in a high tax bracket. So whether you've had a lot of income this year or you sold the property this year, and all of a sudden you're in the highest tax bracket you've ever been in, that would be a good time to look at doing some cost segregation work. Or if you're fortunate enough to always be in the high tax bracket and you're making a lot of money, then you just do it as you buy the properties. We've got a lot of clients that, they're in the highest tax bracket. They need all the deductions they can get. And so they just call us every time they buy a property and say, hey, can you run your analysis on this property? Let me know what my potential savings would be. So that's a good question. What we do is we'll provide that free benefit analysis so that you and your CPA know how much of a deduction is available to you. And then you work with your CPA or your tax preparer to kind of strategize, okay, how do we use these deductions? Do we want to use them all this year? Or wait, maybe next year I'm going to be in a higher tax bracket because I've got all these new rentals and they're, I bought them in December of last year, so I don't have a lot of income from December on. But this year I'm going to have 12 months of income. Maybe this is the year I do the cost segregation study. So it's real flexible. You can kind of pick and choose when you use it, which is rare. A lot of other expenses you have to use in the current year, but cost segregation is pretty flexible in terms of tax planning. All right, we'll continue on here. Okay, so kind of getting into the Tax Cuts and Jobs Act. There was a lot of things that happened. There was a lot of different provisions and stuff, but the main one I want to focus on is what we call bonus depreciation. So bonus depreciation has been around for some time. In the past, this was the old law. You would have to build, right here it says original use property, and all that means is you had to have to build a new duplex. You couldn't buy an existing duplex. So if you built a new duplex and all the items that had a recovery period of 20 years or less, then you were eligible for bonus depreciation. Now I want you to think about this. What is the normal depreciation or the normal recovery period for a duplex is 27 and a half years. So a lot of CPAs tell us, well, this bonus depreciation doesn't apply to real estate, right? Because real estate's a 27 or a 39-year asset. And that's true unless you do a cost seg study. Because now when you do a cost seg study, remember you've got those 5, 7, and 15-year categories. Those are all under 20 years. So in the old world, you built a duplex, you had a cost seg study done. whatever value we assign to your 5-year assets, you got to take, for example, in 2014 through 17, you got to take 50% of those deductions in the first year. So if we determined that your 5-year assets were worth 100,000, instead of depreciating that 100,000 evenly, 20,000 a year over 5 years, you get to take a $50,000 write-off in the first year, or 50% bonus, and the remaining 50,000 would be written off over 4 years. And so it was great for people who were building new properties, right? So the good, and the reason the government does this is to kind of stimulate the economy, stimulate growth. And so they, depending on how the economy is doing, they say, okay, this is a year where we really want to stimulate growth. So we're going to offer people who build new properties all this additional, not additional, but accelerated deductions. And so they put in these bonus, and it was frustrating as tax preparers because we didn't always know what the bonus depreciation was going to be until the end of the year. So you couldn't really plan for it. But it was there for those people who were building new buildings. So that was great. That was the old tax law. The new tax law under the Tax Cuts and Jobs Act, two things happened. One is it no longer has to be new construction. That's a huge difference. I can go buy a building now that was built in 1950, do a cost segregation study on it, identify 5, 7, and 15-year assets. And this is the most important thing, is I get to write off 100% of those, 100%. So we typically in a cost segregation study segregate about 30% of the asset. So let's take a step back and say, okay, you buy $1 million asset. We segregate 30% of that into short asset life, so 300,000. Instead of depreciating that 300,000 over 5, 7, and 15 years, I get to take 100% of that in year one. $300,000 write-off in year one. Again, I make $400,000 a year. I buy $1 million property. Instead of having to pay taxes on 400,000, I'm now only paying taxes on 100,000, which means I just saved about $90,000 in taxes. Now, this bonus depreciation, your property had to be purchased between September 27th of 17 and 12/31 of 2022. Now, we have a new administration in office, and that could change, but currently the tax law says that 100% bonus is good through the end of 2022. At which point, under the current law, it phases out 20% a year until 2027 when it's zero. All right, so let's take a look at another example, that same example of the $1.2 million residential assisted living home. But now instead of buying it in 17 or 14, now let's say we bought it after the new tax law. Remember in our original case study, this 216,000, the number's the same, but you had to divide that up over 5 years, right? Your 7-year stuff was divided up over 7 years. Your $96,000 of 15-year stuff was divided up over 15 years. Under the new tax law, because all of these are under 20-year assets, all of these numbers, the 96, the 12, and the 216, you get to take all those, 100% of them. That's that 100% bonus in the first year. So now you buy a $1.2 million residential assisted living. Instead of, if you don't do cost segregation, you're getting a $21,000 deduction in your tax or in your income. By doing cost segregation, you're getting a $339,000 deduction, which is just crazy. That's a huge difference. It's a difference of $318,000. Now, I want you to see, sometimes people say, okay, well, Erik, if I take all this deduction up front, what happens in year 2? Well, let's take a look. In year 2, if you don't do cost segregation, actually in years 2 through however far down this goes, 27 and a half years, you're going to get a $43,000 write-off every year. You'll see that here. In the cost segregation example, you're taking $339,000, or basically a 30% bump in the first year. In years 2 going on, you're getting a $31,000, almost $32,000 write-off. So you're taking $11,000 less every year going forward. But heck, give me my money now. I'll take the $318,000 now. I'm not going to notice so much an $11,000 difference on my deductions going forward, but I certainly will notice a $300,000 deduction today. Again, take that money, reinvest it in new properties, do what you want with it. And so that's kind of a good example there in that diagram. So in this example, if this were bought after the new tax law, all of a sudden you've got a $318,000 worth of additional deductions. That equates to about $127,000 tax savings at a 35% marginal rate. Huge, huge impact for real estate investors. The tax, and it's not surprising. I'm pretty sure Trump owns a few pieces of real estate. So it was pretty favorable to real estate investors, the new tax law. Here's another example, same example. This is on a $500,000 fourplex. You'll see that in this example, $132,000 of additional deduction. Take that off your taxable income, and that equates to about a $53,000 tax savings. So this works. We do cost segregation studies on anything from $100,000 single family rental homes to ski resorts and golf courses. So it works, a $10,000 tax savings for somebody who owns a single family rental home is just as good as $100,000 tax savings for somebody who owns an apartment building. Just to give you guys an idea on the pricing, usually on a single family rental home, it's somewhere between $1,500 to $2,000, depending on the size of the asset. But I'll pay $1,500 if I'm going to save 10 in taxes. I'll do that all day long. And so we like to see somewhere around a 7 to 10x return on your investment with us. And with these bonus depreciation numbers, it's not uncommon for us to see 100% return where we charge somebody $10,000 to do a study and they're saving $1 million in taxes. So you don't see those same kind of returns on the smaller assets, the single family rentals, but certainly on the larger ones with bonus, we see significant returns on their investment. All right, so that covers kind of the Tax Cuts and Jobs Act. That was the first thing that happened. We have cost segregation. We talked about that. Then we had Trump come along and just basically put everything on steroids. Then we had the pandemic, and we've got the coronavirus stimulus package. And the big thing I want to talk about with the coronavirus stimulus package is this 5-year net operating loss carryback. So what happened was, let's say in our previous example, we had a $300,000 deduction, okay? But I only make $150,000 of income. What happens is I write off my $150,000 of income. I pay no taxes on it. That leftover $150,000, in the past, you'd have to carry it forward into a future year. So you carry it forward. Next year, when I make my $150,000 next year, I'm going to have this deduction sitting there, and I don't have to pay tax on my $150,000 next year. That's great. The problem is that I have to wait a year to realize those tax savings. The government knew that. They said, listen, you're going to have renters who aren't able to pay their rent. You're going to be strapped for cash during this pandemic because people are losing their jobs left and right. So what we're going to do is, instead of making you carry your loss forward, we're going to let you carry your loss backwards up to 5 years. So now, if I have that leftover $150,000 in that last example, instead of waiting and carrying it forward to next year, I get to go back to 2015 when I made $150,000 and paid $40,000 in taxes. I get to write off that $150,000 because I've got this $150,000 worth of deduction, and the IRS is going to send me a $40,000 refund check, which is kind of the point of it, because they wanted to get cash back in investors' pockets because they knew renters weren't going to be paying their rent as much as they had been in the past with people losing their jobs. So the idea was get money back in the pockets of the real estate owners so that they can help through this pandemic. So a couple things have to happen for that to work. One, you do have to file your taxes as a real estate professional. So if you are a doctor but own a few rental houses on the side, and you spend 50 hours a week at the hospital and 10 hours a week doing real estate, you don't qualify. So you do have to have rep status, which you guys are probably familiar with, but it's 750 hours of real estate activities and 51% of your working time. If you do file your taxes as a real estate professional, a lot of those folks are, what they're doing is they're cost segging every one of their properties this year, creating a massive deduction and going back and getting a refund check. The nice thing is that your tax rate was probably higher back in 2015 than it is now. The tax rates have gone down with Trump. Now, they could go back up here with Biden, what he's talking about, but right now your tax rate in 2020 is less than it was in 2015 if you're making the same income. So let's take that leftover amount, that carry forward. Instead of carrying it forward, let's carry it back, get money that was taxed at a higher rate, and get those refund checks today. So couple things, it has to happen on your 2019 taxes or 2020. So even if you've already filed your 2020 taxes, you can still amend and take advantage of this. But this 5-year net operating loss carryback won't be eligible to you on your 2021 taxes as of right now. If something were to, if the pandemic were to flare up again and people were struggling, they might extend it. But currently, right now, it's only good on your 2020 taxes. So that's important to keep in mind. Here's a bit of an example that said if client A has 100,000 of income in 2020, and they do a bunch of cost segregation studies and create a $525,000 deduction, how would that work? Well, first we would wipe out their 2020 income, and that would give us, if they made 100,000 in 2020, see here, they made 100,000. That gives us a carry forward of 425, right? Because we created a $525,000 deduction. So we used 100,000 of it to wipe out this income here. Then you do have to go all the way back to 2015 and start there when they made 75,000. We're going to wipe that out. They're going to get a refund for 15 of 14,000. We keep carrying those losses forward. We run out of losses in 2017, but at the end of the day, they're getting a $115,000 refund check on top of not paying taxes in 2020. So they're basically going back and saying, I'm offsetting my income from 15, 16, and 17, and you guys can send me a refund check. Very powerful stuff, especially, like I said, for those of us who've got renters who maybe aren't paying rent and we're looking for cash. There may be an opportunity for you to generate serious cash flow by doing cost segregation studies on all your properties and carrying it back. Anybody have any questions on that? Like I said, that's kind of the coronavirus stuff. Wanted to share that with you guys.
Another one that's come in, and this is the time to bring that up since you're on the topic. So when people that are, especially investors, because that's more our audience at the moment rather than real estate professionals. So let's say they're currently working with the CPA because of their investments and any one of a number of things. Sometimes that's their personal taxes. They may have a variety of LLCs. So where does what you do fit in with? In other words, if I'm already, if I say, but Erik, I've already got a CPA, then how does this all integrate, or how does this work for their benefit?
Yeah, so cost segregation is kind of a niche accounting service. And so we partner with CPA firms all over the country and do this work for their clients. And so your CPA, unless you're working with one of the really large firms out there, your CPA probably doesn't have access to a cost segregation department. Some of the large CPA firms have some in-house cost segregation professionals, but really what it requires kind of a constructional engineering background and a tax background. So your CPA has the tax background, but they don't necessarily have the expertise to go in and dissect these buildings and put values to all the different components. And so they usually will partner with a company like ours to get these done. So typically how this works is oftentimes investors will contact us and say, hey, I own a bunch of rental properties. What should I do? We'll run some numbers on each of the rental properties, and then we'll say, okay, here's what we have available to you. Let's get your CPA on the phone now and see if you can utilize these deductions. And we may find out, they don't need the deductions because they made a charitable contribution this year of $1 million. And so they've got enough write-off for this year. That's great. We just want to give you guys the information and your CPA the information, say, okay, here's what's available to you. You and your CPA can determine when to best utilize that. And like I said, we'll partner with your CPA. A lot of CPAs have heard of cost segregation. They've heard of this bonus depreciation. They don't necessarily know how it applies. They know how it applies if I bought a bulldozer. They know, okay, a bulldozer is a 15-year asset. I get 100% depreciation, et cetera. It's easy. But how do you apply it in a real estate setting where I'm buying a 27.5-year asset or a 39-year asset? It doesn't always, they don't understand the different complexities of that. And so that's why they usually will partner with us. This is all we do. We don't do any tax returns at our firm. All we do is cost segregation. And so that's kind of how we integrate with you, the building owner, and your CPA.
Okay, great answer. Appreciate that very much, Erik. Another question, and again, it's topical. If an investor or landlord, in this situation, some of them were able to get I don't know if we want to say grant is the word, but because of COVID-19 from the funds that were available, it might have been to operate a business, but they own the building, or in some way it fits in with the real estate. How might or does or doesn't that affect the cost segregation now for either 2020 or here for 2021? How is that fitting into your picture, your scope?
Yeah, so it doesn't actually affect the cost segregation study at all. It would be a completely separate animal. So we would still be able to do the cost segregation study. Depending on the type of loan or grant you got, you may or may not have to recognize that as income. If you do have to recognize it as income, the cost segregation study would help defer or get rid of some of those taxes that you have to pay on that income. Like I said, depending on what type of loan or grant you got, if you have to recognize it as income, now all of a sudden you're in a higher tax bracket. It may be a good time to do a cost seg study to put you into a lower tax bracket. But in terms of the actual study or the deductions, it really wouldn't impact it much on our end at all.
Okay, appreciate that as well.
All right.
I'm not seeing any other questions, so
All right.
we do
I think
want
we're
to do,
about
Erik,
done.
is be sure to put your contact information on there and a little bit more about someone wants to contact you and do this. What information are they going to need? What do you need to get started? And just kind of
Sure.
wrap things up a little bit, because I'm sure there's people thinking, yeah, I should consider this for this property. So what do they need, and how do they go about it?
Sure. I've got one other slide. Let me just talk real quickly, and then I'll give you my contact
You bet.
information, because I
You
think this
got
is important.
Sure.
But we've got the new administration. As we know, Trump is no longer the president. We've got a Democratic president, and so the chances of taxes going up is probably pretty good. Whether it'll happen this year or next year, I think they're kind of focusing on the coronavirus stuff now, but my guess is next year there'll be some type of tax overhaul. I don't know how big it'll be or when it will take effect, but here's some of the things that they're looking at that I think is important for all of us to consider. One is the corporate tax rates could go from 21% to 28%. So that's a 9% tax increase on corporations. The second would be that these are all things that they're floating around. I don't think this is kind of in its first form. I don't think they're going to pass it with all of this stuff in here, but just stuff to be aware of. You've got long-term capital gains could be taxed at ordinary income rates for taxpayers who report over $1 million of income. So right now, long-term capital gains are taxed at 15% or 20%. That could go up to 39.6% if you make over $1 million a year. So that's a significant jump. Another thing, tax rates for high income earners could go from 37%, which is the highest rate or the highest bracket now, to 39.6%. And that's for single filers reporting over 452,000 of income, or joint filers reporting over 509,000 of income. So if you're making over 500,000, your tax bracket is probably going to go up at least 2.6%. Capping the deferral from 1031 exchanges. A lot of us in real estate will use a 1031 exchange to defer capital gains and defer the recapture tax. They're talking about getting rid of that altogether, or at least getting rid of it for any income over 500,000. So again, and then the last step, which we didn't really get into much, but eliminating the step up in basis upon death. So right now, if I die and I pass my rental portfolio onto my child, they don't have to pay any of the gains on that rental portfolio. They get a step up to fair market value. They don't have to pay recapture. They don't have to pay capital gains. That could go away. And so, again, all things to think about when looking at what your potential tax brackets are going to be, what potential taxes you're going to pay in the future. There's a lot of money being printed right now. We've got to pay for it somehow. And it's going to be, the current administration wants to pay for it by taxing more. And so I would think that's pretty safe to say that taxes are going to go up for all of us in the next 4 years. How much they're going to go up, I don't know. But just something to be keep in mind, because I think that cost segregation is going to become more valuable as taxes go up, because now you're paying a bigger portion of your earnings to the government. So let's offset that income so that your taxes go down. And so again, just things to be aware of. My information is right here on this page. Like I mentioned a couple of times, we do a free benefit analysis. So if you want us to look at a property or a portfolio of properties, I just need a little bit of information. I need to know when you purchased it, the year and month, the acquisition cost, the type of asset, and the address. From there, I can look at it on Google Earth. I could pull it up on the county docs and give you a pretty good, pretty accurate idea on what type of deductions you have available in that property and what the potential tax savings would look like. We also obviously include our price there. Like I mentioned, pricing can be anywhere from $1,500 for a portfolio of single family rentals up to $20,000, $30,000 for a ski resort. So it all just depends on the size and scope of the project. My contact information is there. Again, my name's Erik Oliver. That's my cell phone number. I try to answer that as much as possible. That's my email address. You can email me directly if you have a question, or if you'd like us to take a look at your properties, we'd be happy to do so. Or Dave always has my contact information as well. If you can't get a hold of me, Dave, let Dave know, because he knows how to get a hold of me as well. So anyways, that's about all I've got, Dave. Hopefully that was of value to you guys. We'll try to keep updates coming as they become available. Like I said, we're kind of with the new administration. Once I think we get through this COVID stuff, I think there's going to be some significant tax changes made. And we'll try to keep you guys abreast on how those are going to impact you guys as investors. But like I said, hopefully you found value today, and I appreciate your guys' time. Thanks, Dave.
And thank you very much, Erik. And let's also mention that you can also get a hold of Erik. And thank you, Judy, for thanking us. You can also get a hold of Erik by going to the sponsor directory on the REI USA website. So that's still another reason. And thank you, Cynthia, as well. We appreciate that. So again, check that out on the sponsor page as well. I think we've even got a direct link to the website for Cost Seg Authority. Well, it's also on here, costsegauthority.com, so we can connect you that way. And don't forget, keep checking the calendar with REI USA. We've got more great events coming up in the near future. Erik, we will have you back on in a few months, and that could be a great topic again for toward the fall or toward the first of the year, just to see if or how these changes go about and kind of see what happens. And one last thing, if you and when you do contact Erik, be sure to let him know that you're an REI USA member, because that can get some special things done as well. I thank you, everybody. We will let you all go. Appreciate your attending and your participation with REI USA. Have a great night. Thanks again, Erik.
Yeah, thank you, guys.
Thank you. Bye-bye now.